Thank you for joining us for our year-end tax planning workshop. My name is Dave Mantell. I'm a certified financial planner and partner with Stabler Wealth Management. For today's workshop, we'll be reviewing proactive year-end tax planning ideas for both 2022 and beyond. We'll also look at key pending tax law changes that are potentially on the horizon. We strongly believe that a proactive approach to tax planning instead of a reactive approach makes a huge difference and drives much better outcomes. So we'll cover a lot of those strategies in this video today. Of the 5 key areas of financial plan, we'll be focusing on the tax planning component in today's workshop session. And going into 2022, there was a lot of noise about sizable tax law changes potentially coming to fruition. Despite many of those proposals that we've seen over the last couple of years, the only item that's been passed to date is the Inflation Reduction Act of 2022. This act has a minimal impact directly on most tax preparers. A couple items of note, it does include a minimum corporate tax rate, which has an impact on companies, as well as potentially, market outcome. And so that minimum tax rate's at 15%. And then in addition, there was an extension of the private health insurance marketplace rule that went into place during COVID as part of the Affordable Care Act. And so those extensions are to occur for several more years and is meaningful for anyone looking to retire before Medicare age, so before the age of 65, and does provide quite a bit more flexibility. So that is a positive in that department for folks looking to retire before the age of 65. So when we're approaching tax planning, this is very different than tax preparation. So tax planning is what we can do throughout the year to proactively improve your tax picture and essentially drive tax savings both now and down the road for both you and your family. Tax preparation is the act of preparing tax returns. So that is not something that we're going to cover in this session. It'll be focused on tax planning specifically. Tax preparation is something that you will work on with either your tax preparer or if you file your own tax returns. But proactive tax planning is something that we're very involved in with clients. So starting off, when we look at the tax brackets for 2022, it's still the 7 tax rates. Those are 10%, 12%, 22, 24, 32, 35, and 37% tax brackets. These tax brackets are quite favorable from a historical perspective. And something that doesn't really get recognized often is that under the current law, these tax rates are scheduled to sunset and phase out in January of 2026. So these tax rates were put into place by Trump, as part of the Tax Jobs and CARES Act, several years ago. And even if no new tax laws are passed, we're going to revert back to the prior tax rates starting in 2026. As a result, it's important to have a whereabouts of where you currently are in the current tax brackets, especially because we do anticipate the tax brackets rising as we fast forward a few years. And so looking at this tax chart, on the left-hand side in the blue is the 2022 tax rates. The right side, so the red, this is mislabeled, but that's actually the tax rates prior to the Tax Cuts and Jobs Act, TCJA. And as a result, this is what we anticipate tax rates reverting back to starting in 2026. And so as you can see right now, the tax rates are quite favorable. The 24% tax bracket, this is for married filing joint for illustrative purposes. Single filers will be half of these tax bracket thresholds. But the married filing joint tax bracket, a couple can show $340,000 of taxable income after standard deduction, right? So $365,000 plus in many cases of gross income, and still only be in the 24% marginal tax bracket. As we fast forward to when these tax rates sunset and starting in 2026, you can see that much of this income that's now in the 24% bracket would actually be now at the 33% rate going forward once the tax brackets revert. That's a nearly 10% increase in tax rates, so quite sizable. And of course, we don't know what tax rates are going to look like down the road. While many states do have state income taxes that we need to manage around, Washington state currently does not have a state income tax, right? And that's something that we're always keeping an eye on as well. And so with the current brackets, they're very favorable. And there's quite a few strategies that we'll get into in terms of how to maximize these tax brackets. So one item to look at too is evaluating the use of itemized deductions versus standard deduction. So again, going back to the TCJA Trump tax laws, one item that came out of that was essentially the doubling of the standard deduction. And so for 2022, you could see a married filing joint couple has a $25,900 standard deduction without itemizing that they're able to reduce their gross income by. A single filer is $12,950. And then once you're over the age of 65, that adds additional standard deduction to that amount. And so the old rule when looking at itemized deductions was to accelerate. You wanted to use your itemized deductions as quickly as you can, whether that was a charitable gift, deducting property tax, and get that tax savings right away. Based on these larger standard deduction amounts, the new rule is more to time or plan your deductions. So for example, someone that, has, let's say they have property tax, right? That's capped at $10,000 now. If you don't have anything else to itemize, you're quite a bit below the standard deduction if you don't have a mortgage, for example. Therefore, a couple that, is giving $10,000 a year to charity, may get no tax itemization credit for that. As a result, they're still under that $26,000 between property tax and charitable giving. Someone that donates more to charitable giving, for example, they're really only benefiting from a tax perspective on any charitable giving that takes their itemized level over that $26,000. Before that, it's a wash, right? You get the same deduction amount by taking the standard. And so with the new rule, you can look at planning and bunching these deductions to stack them in current years as a result. And so, looking at, again, like I noted, with some of the changes in the past, for deducting mortgage interest, that's capped at $750,000 a year. So that's something to consider for married filing joint or single. State and local taxes, including property tax, is limited to $10,000 a year deduction. And so again, there's some limitations where in many cases, folks will end up taking the standard deduction. Oops. And so going back here, looking at ways to potentially time your deductions and bunch them. For example, do more charitable giving in a certain year when you're going to itemize and take the standard deduction in other years could be a good route to go. And there's tools out there such as a donor advised fund, which allows you to bunch your itemized deductions to get the tax benefit in 1 year, but then release your charitable gifts to the charities of your choosing in the years as you desire from that donor advised fund is a good tactic. So if that's something that you're interested in, I do suggest we talk about that because that's one way to bunch in time your itemized deductions to get the most benefit from it from a tax perspective. Okay, another item to look at is capital gains rates for 2022. So the long-term capital gains rate is 15%, for most filers. If you have income over certain thresholds, over $517,000, if you're married filing joint, then you get into the marginal 20% capital gains tax rate. Again, these tend to be pretty favorable tax rates. During Biden's election campaign, he was proposing doubling the capital gains tax rate to 40% for many filers. None of that has passed. None of that has happened. So we're still operating under these more favorable capital gain tax rates. Something to note is if you're married filing joint and your taxable income is under $83,350, or if you're a single filer and your taxable income is under $41,675. So again, that gross of your deduction could be, more like $110,000 in gross income, or $55,000 in gross income. You're actually in the 0% capital gains bracket. And so even if you have capital gains taxable activity on your tax return, if you're within that threshold that I noted, you pay a 0% capital gains rate on that. And so again, when looking at bracket management, managing your tax brackets, that's another strategy to make sure we're taking advantage of that 0% tax rate on capital gains where we can. So a couple strategies for timing your capital gains in tax loss harvesting. One of which is called harvesting capital losses. And so what tax loss harvesting is it's selling an asset from a non-retirement account, right? So that could be like a stock holding at a temporary loss. And by doing so, that can offset future capital gains. So that's called tax loss harvesting. And so, this is a good time during periods of market turbulence where you could look at your portfolio and look for opportunities to do tax loss harvesting in your non-retirement account. And so again, we could, do that by selling a non-retirement investment that's temporarily down, buying a similar investment or rebalancing into a more appropriate investment, and you're able to realize and capture that tax loss. That tax loss can then be used to offset capital gains that may occur. If you don't use it all in this current tax year, you could roll your remaining loss to future tax years until you use it all up. And so that's a good strategy to take and accomplish tax savings today. Another fact with that is taxpayers can use up to $3,000 of capital losses to offset ordinary income. So if you have more losses and gains as a result of tax harvesting, 3,000 of that loss can offset ordinary income, which is generally at a higher tax rate that you're able to reduce. So that's a good strategy as well. In some instances, you may look at harvesting capital gains. I'd say in most cases, this may not come into play. However, there's some times where it may make sense. For example, like I was noting prior, if you're in the 0% capital gains bracket, you might as well be taking gains on some of your investments at a 0% tax rate to reset your basis on that. So that's one example. Likewise, if we do see tax law changes come back into play that would increase the capital gains rate, we may want to, take capital losses at a more favorable rate before those new higher tax rates are introduced. Again, there's nothing currently on the table that has us suspecting we're going to see capital gain tax rates go up in the near term. But, that could be a scenario where if we do see new tax laws coming, where you may want to harvest gains at a more favorable tax rate. But again, in most instances, capital loss harvesting is more of a strategy that we would suggest for most folks. Okay, another item as we're coming up on the end of the year is planning your retirement contribution to maximize the tax savings and tax vehicles at your disposal. And so this is a good time to review your contributions to your retirement accounts. And so for someone that's still working, for 2022, you could put $20,500 into a 401k, either pre-tax or Roth through your employer. If you're over the age of 50, you could do an additional $6,500. So that brings that amount up to $27,000. In addition, if you're within the income limit threshold, you could contribute $6,000 to a Roth IRA or a traditional IRA. And if you're over the age of 50, that's another $1,000. So that's $7,000 a year. And so that's a really neat vehicle, especially Roth IRA accounts, if you're within those income thresholds. And so that's something to really look at. If you make too much income to contribute directly to a Roth or a traditional IRA, the backdoor Roth IRA is still in play. And what that does is allows you to put money into a traditional IRA, even if you're not able to deduct it, given you make too much income. And then you can then convert that money to a Roth IRA, and so that's kind of a backdoor way to get money into your Roth. If you're interested in this strategy, really encourage you to talk to us about it. There's some nuances regarding this. For example, if you have other IRA accounts, it can result in unwanted tax activity. But in certain cases, this can be a good technique. The other thing I want to mention on this page is if you look at the lower dark blue bar, you could see overall limit on contributions to your defined contribution plan is actually 61,000. If you're over the age of 50, you get the additional catch up, so that's 67,500. And where this comes into play is a lot of employers, such as Boeing and Microsoft now, offer the ability to put even more into your 401k on top of the 20,500 through what's called after-tax contribution. And similarly, this is what we call a mega backdoor Roth. You could contribute this extra to that after-tax bucket and then convert it to a Roth IRA. And so that's a way to really supercharge your retirement contributions. And so again, this is company by company. Business owners have some flexibility in these areas as well. But if you know of somebody or you're in a situation where you work for a company that has that after-tax 401k option, that's something to really look at to maximize those benefits with a mega backdoor Roth ability. So another strategy with year end, which is really coming into play these days, is Roth IRA conversions. And so what a Roth IRA conversion is it's taking money from a pre-tax retirement account, such as a 401k or a traditional IRA, converting it to your Roth account and paying the taxes now at your current tax rate. But once that money's in the Roth, then it's able to enjoy tax-free growth for the rest of your life, as well as that for your heirs. And so this has been a really popular approach as we want a favorable tax brackets now. So we're able to, do Roth conversions in many cases at a very favorable tax rate. And then also, it's a really good time to do Roth conversions with the stock market down, because you're moving money from an IRA, a pre-tax IRA, to a tax-free Roth when the market's low. So when the market bounces back, all that growth is tax-free in the Roth account, rather than coming back and bouncing back in your pre-tax IRA, where when it comes out, it's taxable. So again, a really opportune time to look at doing this now, given the low tax bracket, as well as the market, pullback that we've seen so far this year through 2022. And so, again, looking at a Roth IRA, the benefits are to lower your overall taxable income long-term. Money in a Roth, you never pay tax on. There's no RMDs, no required minimum distributions on a Roth. So it could be a good strategy there. You get the tax-free compounding where all the growth in the Roth is happening tax-free. This provides a lot of tax diversification flexibility, where we can work with you with your investments to hold certain investments in a Roth that are going to be more growth-oriented. And then your income investments are better placed commonly in a more traditional IRA, where all the gains will be taxable when it comes out. And so that provides a lot more flexibility on the tax-free compounding. Like I noted, no RMDs on a Roth IRA like you have on a traditional IRA or 401k. And then this is a big deal, is tax-free withdrawals for beneficiaries. And so the way that the rules work now, as a result of the Secure Act, is that when your heirs inherit your retirement accounts, they have 10 years to draw that money out. And so that means if you're inheriting a big chunk of money from a traditional IRA, that's going to drive and result in a lot of taxable income on top of your heirs' own tax picture. And so with a Roth IRA, your heirs still have 10 years to draw that out, but they can stretch that out tax-free over the 10 years. And so again, as a result of the Secure Act that came into play in 2018, and that 10-year withdrawal requirement for beneficiaries that inherit retirement accounts, the Roth IRA becomes much more favorable, where your beneficiaries can inherit that as a Roth, When they pull that out, there's no tax, and it can grow an extra 10 years tax-free as a Roth account. So again, a lot of different aspects working in the favor of Roth IRA conversions at this time. Yep. So kind of build on that. Family tax bracket management is a really important concept with a lot of these tax law changes that we've noted. So as a result of the Secure Act, when your heirs inherit your retirement account, they have 10 years to pull that out. And so when evaluating whether to do a Roth conversion or take certain draws from retirement accounts, one aspect to look at is, okay, what is my tax rate now that I'll be paying for that Roth conversion or that IRA draw? And then what's the tax rate that my beneficiaries are going to be paying? And so, for example, if you're in a favorable 12 or 24% tax bracket, it may make sense to do Roth conversions or draws from your retirement accounts, pay that 24% tax now, and then that way, when your heirs inherit those accounts, that will not pile on as additional income on their own tax picture. And between their own, income picture, between the 10-year withdrawal requirement for inherited retirement accounts, they could be looking at a much higher tax bracket than you are in. And so for any money that's intended to pass to your heirs, it could be really, valuable to do Roth conversions, retirement draws at a, more favorable tax rate that will protect them from paying a higher tax rate on those funds down the road. Another item to think about is when you do a Roth conversion, yes, you're paying the tax now. However, by paying the tax now, that's reducing your taxable estate when you pass away. And so again, by paying the tax now, when you pass, that may be less a less asset balance, less estate taxes for your heirs down the road. Because when your family pays estate taxes on your estate, the IRS isn't saying, well, you have $2 million in a retirement account, but after taxes, that's really $1.5 million. They're just taxing you on the high level headline amount. And so again, that's another benefit is paying the tax now can save estate taxes as well. And so again, this is pretty nuanced. It's something, I suggest you review with us. So if this is something that might apply to your picture that you're interested in, please give us a shout on this and we could look at it for your specific picture. But again, if one of your goals is to pass, wealth and transfer wealth to your family with minimal tax, this could be one important, avenue to look towards doing that. Okay, a couple other items to hit on. Qualified tuition plans, so 529 college savings plans are a really great vehicle to consider. Again, a 529 account used for educational purposes is a way to, basically achieve investment gains tax-free. So you could fund a 529 account for yourself, a child, a grandchild, and that money could be invested in there. And as long as it's used for qualified educational purposes, when the money comes out of a 529 account down the road, there's no tax on the gains. The definition and use of these has really broadened over the years. And so again, it could be used for books and tuition. In many cases, it could be used for, dorm or student housing costs. It could be used for trade schools. And so again, it's a very practical vehicle. And this is a great way, for you to help your grandkids or help your kids fund their kids' education. And so you can gift into a 529 plan for a grandchild, for example. And so these are great vehicles to use. And again, inside that 529 account, that money can be invested and grow. So over the years, when it's needed for educational uses down the road, the intent is it could be a lot more than it is today. One other note, so I'll hit on this in a moment, but you're able to give $16,000 a year to any recipient as an annual gift tax exclusion amount. So no reporting, no taxes or anything. 529 allows you to gift 5 years at once to any recipient. So you could speed up some of those gifts. And so, for example, you could gift up to 80,000 at once. But if you wanted to put 30,000 in and not be limited to the 16,000, you can do that in a 529 and fast forward some of your, again, free gift amount. So again, that's kind of a neat way that allows you to pinpoint the exact amount you want to contribute to one of these. Talking about annual gift tax planning, the gift tax exclusion for 2022 is $16,000 per donee. And so that means you can gift to any recipient $16,000 in the calendar year, and you don't have to report it. The recipient doesn't report it. There's no taxes, no strings attached. This is again per donee per recipient. So you and your spouse can gift each of your children 16,000 each, right? So 32,000 in total. Likewise, if they're married, you could give 64,000 to them and their spouse as part of this annual gift tax exclusion amount. And so again, it's a really effective way to do gifting without the administrative burden. It was announced for 2023, this is going to go up to 17,000. So they've upped that with inflation increasing. But this is a really powerful way to do gifting, manage future estate taxes on an ongoing basis, and help out family and loved ones now without feeling the need to have to do a massive gift down the road to avoid estate taxes. And so this is a good strategy to really move the needle over time, set up an ongoing gift plan that will really manage future estate taxes and estate tax thresholds while helping your loved ones today. When looking at wealth transfer planning for 2022, the federal exemption amount for gift, estate, and generation skipping trust is still a whopping $12 million a person, $24 million per couple. And so most families are not worried about federal estate taxes. Again, under the current rules, your assets, your estate would have to be over 24 million per couple to be subject to federal estate tax. This number is set to go down in 2026 to 6 million a person, 12 million per couple. And so I do think we should operate under that assumption that we'll be looking at that 12 million a couple rather than 24 million, with the expectation that we'll go back to that number starting in 2026 once the current rates sunset. But again, that still provides a lot of room. Again, that means as long as you have under 12 million of assets in your estate when you pass away, there would be no federal estate tax on that. And so a couple things to note here. This is portable. So again, it's per a couple, not per an individual. And so if you pass and your spouse survives you, they get your benefit amount, right? So under the current rules, they'll have 24 million protected, not just their 12. So it is portable. Your spouse receives that. Another note is that with the annual gift exclusion amount that we noted on the previous slide, 16,000 a year, going up to 17,000 a year. If you wanted to gift more than that, it doesn't mean it's going to cost you or your family any taxes. It just means you're using part of your lifetime gifts. And so if you gifted 100,000 rather than 16,000, that's 84,000 more than the annual, free amount. That means you're using up 84,000 of your lifetime gift amount. So rather than 24 million between you and your spouse, you only have 23.1 million left, right? And so again, by gifting more than the annual gift exclusion amount doesn't mean that it's going to cost you or your family any additional tax. It's just administratively, something to consider and manage. If you do gift more than the annual gift amount, the 16,000 increasing to 17,000, you have to report when you file your taxes that you're using part of your federal lifetime gifts. And so it's an additional administrative step, right? You have to report that additional gift that you're doing. But as long as you're not using up or expect to surpass this federal estate tax threshold, it doesn't mean it's going to cost you or your family any taxes. It's just a reporting component to consider. And if your estate is over the federal exemption amount, then anything above that would be a 40% tax when you pass and when your heirs inherit it. So again, a really sizable tax amount. So we want to really manage these thresholds. Washington has its own estate tax, and as does Oregon as well. California doesn't. But yeah, zoning in on Washington, it's a much lower number. So 2,193,000 is the Washington estate exclusion amount, and this is not portable. So what that means is for a married couple, if one spouse passes, their 2.2 million does not automatically go to the surviving spouse. So if one spouse passes, if a couple does no planning, now the surviving spouse is worth twice as much, but they still only have the 2.2 million protected, the 2,193,000. And so for anyone whose estate is over $2 million in Washington, really important to have a proactive plan here. The good news about the Washington, state exclusion amount is it's an estate tax. It's not a gift tax. And so the state just looks at what your estate is worth, what you're worth the day that you die. It doesn't look at the gifts that you've made in the past. And so, for example, if someone is worth $4 million, and so they're way over that 2.2 million, they could technically gift $2 million the day before they die and get under the 2.2 million, right? So unlike the federal estate tax exemption, the Washington amount is a state tax. It's not a gift tax. And so it does, any gifts you've made previously do not play into that amount. Something else that's really important in Washington, like I noted, there's no portability. So if your spouse passes, you don't get their 2.2 million. There's ways to work around this. And so the most common way is just about anybody in the state of Washington, you want to make sure that your estate plan, your will has provisions where a credit bypass trust will be established upon the first spouse passing. And what that does is when one spouse passes, their 2.2 million protected from Washington estate tax can go into a trust. The surviving spouse will be the trustee and beneficiary on that trust. So they'll still control it, be able to access the funds and the assets in there. But by doing it this way, that couple has 4.4 million that they can protect from Washington state tax. So again, when the first spouse passes, up to 2.2 million can go into that credit bypass trust. The remainder will go into the name of the surviving spouse. And that way, 4.4 million is protected rather than 2.2 million. And so this is a really critical strategy, especially how much real estate and home prices have gone up over the years. It doesn't take a lot to hit that 2.2 million threshold in many cases. And so having a proactive plan on how to manage this is very critical. And so again, yeah, we really recommend if there's something that resonates with you, let's talk about it and map out a game plan together. So we're prepared on how to avoid Washington estate taxes. Because again, in most cases, these are completely avoidable. And looking at the chart, the Washington estate tax, so once you're above that exclusion amount, once you pass away, starts out at 10% on the first million above that 2.2 million. The next million above jumps up to 14%, and the tax continues to increase as you go from there. Looking at charitable gift tax planning strategies, qualified charitable distributions, QCDs is a terrific strategy that's still in play. This applies to retirement savers. So once you're over the age of 70 and a half, 70.5, you can gift $100,000, up to $100,000 each year from your IRA to charities of your choosing. And what's neat about this is it's not reported on income, right? So you don't have to worry about itemizing your taxes. Should I bunch to be above the standard deduction? Whatever you give from your IRA as a qualified charitable distribution, does not show up as income on your tax return. And so once you're of RMD age, so once you're 72 and taking required minimum distributions, you could donate your RMDs as part of this QCD, Qualified Charitable Distribution Strategy. And that's a great way to reduce your taxable income, because any RMDs that you donate as a part of this does not show up on your tax return as income. So this is a real terrific strategy for those that qualify. And we could help you do this directly from your retirement account, so it's done properly. So please contact us if this is something that's of interest to you. Yep. And as noted, even though the RMD age is 72, you can do qualified charitable distribution. So gifts from your IRA at the age, charitable gifts from your IRA at the age of 70 and a half. But it tends to be most effective by doing these out of RMDs. So once you hit 72 is where it really becomes effective, especially. So looking at tax law changes going forward, as we know, tax laws are always changing. So it's something that we're always keeping our finger on to make sure we're proactively approaching the current tax laws and new tax laws in the best way possible. And so Biden did come out with his green book for fiscal 2023 on some proposals from a tax law perspective. Couple things to note. One, none of these proposals are that meaningful to most tax preparers. So they will not impact most tax preparers dramatically. And two, a lot needs to happen for these to get passed. Again, to put in tax law changes, you need a full party control of both Congress and presidency. And so with midterm elections coming up, the Democrats would have to control the House and Senate for us to expect for any new tax laws to go into effect in the coming years. The Green Book proposals Biden put out there, if they are able to pass them, would be increasing the corporate income tax, a billionaire minimum tax. So for any billionaires, a minimum tax of 20%, and then restricting 1031 exchanges. So for example, you could sell a real estate property and roll those capital gains into a new property purchase. So putting some restrictions there. And so, the 1031 is something that comes up quite a bit, but, otherwise, for example, the billionaire minimum tax won't impact most people. And so the initial proposals that Biden had when he was elected for presidency, which were much more significant than this. This is quite pared back. And again, unlikely much of this will be passed anyhow, unless the Democrats maintain control of Congress with the upcoming midterm elections. So these are some strategies for proactive tax planning that can really drive some meaningful tax savings for both you and your family going forward. If you have questions on any of these strategies and interested in reviewing with them with us, please contact us. We'd love to look at these for your individual picture. So please reach out to our office and we can look at these and any questions that you have. Likewise, here's a checklist for year-end tax planning items to look at. So I do recommend walking through this checklist and seeing if any of these jump out as meaningful items to you. That includes tax bracket management to take advantage of the more favorable tax brackets we currently have, like I noted. Itemized deduction timing, bunching your charitable giving and itemized deductions, potentially using a donor advised fund. Retirement contribution planning, 529, strategies for charitable gifts like QCDs. So take a look at this checklist and please come to us if any of these are items you think may resonate with you or be something you're interested in looking at before year end is up here. And in addition, as a client benefit to you, please let us know if there's any names, family, friends, colleagues that you think would benefit from this information, and we'd be happy to add them to our communications list. In general, our firm is growing. The way we, get introduced to most of our clients is, being introduced and referred to friends, family, colleagues that you think may be able to benefit from our services. So if you know of anyone that you think may find value in meeting with us, please let us know. Please pass on our information. One strategy that works pretty well is you could send an email introduction. So, send an email to us, include your friend, colleague, family member on there that you think could benefit from meeting with us as well. And so that's a great way to introduce us. But again, we're happy to meet with anybody, provide our feedback on their picture, go through tax planning strategies. So if you have anyone in mind, please don't hesitate to reach out and get us introduced there. So thank you again for taking the time for joining us for our year-end tax planning workshop. Please reach out if you have any questions, and looking forward to helping you with these proactive strategies and helping you accomplish all your financial goals. So thank you again for joining us today.